public speaker. He is a full-time trader. Okay, and not many people can be a full-time trader, and he is a living example of how he can trade full-time and make money. So in other words, he has no trading full-time is his income. Okay, if he did not make money in trading, then he really did not have income. So to be a full-time trader, he has to be really profitable, and he's one of the people who have done it really big, and he's also a local participant of Bursa Malaysia derivative. So he trades a lot of Bursa Malaysia futures as well. So he is none other than the founder of Straits Index Sdn Bhd, which is a proprietary trading company and associate participant of BMD. Right? He's also a speaker for SIDC and also various magazine and for example, Money Compass, Sinchu Daily, and he's columnist for them for more than 10 over years. So you want to see his column, you can buy Sinchu and buy Money Compass magazine. Okay, so without further ado, let me hand it over to you, CC.
Hi, Junsen.
Yeah.
Thanks.
Thanks for joining this. Yeah, thanks for sharing your experience with us today.
My pleasure.
Okay, I am making you the presenter now.
Okay. All right. You can see my screen now?
Yes, perfect. Seeing your screen.
Okay. Good evening, everybody. So thank you, Junsen, for introducing me. So let's, without further ado, we'll start the webinar. Today, our topic will be on oscillator. It's one of the, I think, most commonly used indicator. Actually, in technical analysis, you can use any indicator that you want. I'll share with you some of the basic of this oscillator and the popular oscillators like RSI and Stochastic. And then, most importantly, I will apply this in a strategy. You don't have to really like make use of what the percent, what is the way to use it. Most important is actually how to apply this into your trading and the process of acquiring all this. Well, first thing first, technical indicators. This is the definition. So they are mathematically calculations based on the price, volume, and so on and so forth, right? So you analyze the historical data. The technical analyst, or what we try to do, is actually use these indicators to predict the futures of price movement. Although sometimes or most of the time I say we almost cannot forecast or predict the future, but yeah, we try to know what is the direction of the market. So from here, we try to use or apply this indicator in our trading. Now, the basic first thing, is oscillator is actually one indicator that it varies over time within a band, above and below certain levels. So which we can see apply this. I'll show you in a chart. Okay, so usually it will tell you two levels, which is overbought and oversold. Okay, this is actually very close, really related to support and resistance. So if you apply together, so it should actually give you some positive result in your trading. So we'll focus on two only, which is RSI and Stochastic. Now, RSI, or relative strength index, so it's actually check the power or the momentum of a certain price. So in this case, we can apply to stocks, indices, futures, so any commodity with price, So this is the fundamental, which is actually developed by Willis Wilder, and this I consider is a midterm momentum oscillator, which measuring the relative strength of price change. So usually, if this indicator is actually above 70%, so we will say the price is actually in a bullish, or sometimes you can say it's actually overbought. Okay, but overbought is actually means bullish. In a bullish market, the overbought can be keep on continue to be overbought. Okay, so it is bullish. So that means if you see the indicator is above 70, don't sell just yet, because it's actually showing you the price is actually quite bullish, but the uptrend may end when it falls out of 70%. That means it dropped below 70%. Then only you try to sell it. Okay, and then in contrast, oversold is when the indicator is actually dropped below 30%. So oversold, usually If also means you can buy, right? No, you can prepare to buy, you can accumulate or build position, but definitely it's not a sign that the price will immediately rebound usually. So because oversold means bearish. Okay, whenever the market is in bearish mode, it will become oversold and oversold and oversold. So that's why a downtrend may end only when it break above 30%, which is that means the RSI break 30%. So you can see this is a chart showing you the RSI indicator of one particular stock in Bursa Malaysia. All right, the line indicator is actually 70%. So that means any price above this 70% theoretically is actually over bought, which is bullish, or you can prepare to sell. This is the signal is indicate. And another one is below 30%. So these two levels is the one that you need to take care of. Of course, there is some software or analysts or traders, you may actually use 80% or above 80% or below 20%. You can actually play around with this. Later on, I'll show in a computer simulation showing you that why you can actually apply either 80, 70, because the most important thing is you understand when something turns from, let's say, overbought, okay, if reverse or whatever price or action inverse of overbought means the uptrend ends. So then you can start thinking about selling, right? This is the two important level you can keep in mind. Now, the basic of it is, if you want to know the formula, this is the formula. It's very simple formula. So I'm not going to explain in detail, but basically it's showing you the average gain and average loss of a particular time. Let's say, for example, 14 days. Okay, whether most of the day is actually going up or going down. So from there, it measures the relative strength, because it relative means over the 14 days period. It doesn't mean measure after the next 14 days, the 15 days. It don't care. So that's how it works. All right. So from here you can see that somehow RSI will fire certain indicative signal, where, for example, in this case, if from a bearish mode, when RSI break above 30%, all right, it actually tells you it could be a buy signal, right? And then vice versa, when it's actually reached 70% and drop from the 70%, it could means a sell signal. So that means basically you can apply break 30 to buy, and then break below 70. Okay, break to 70 is actually good because you can keep the stock, but once it break below 70, then you can consider to sell a particular stock. This is just theory, okay? But we will apply this whether this is working or not. Okay, we pick one example in later. Okay, and then another signal is you should actually sell when a stock or RSI, the stock price, which their RSI actually fell below 30, because it's not, the price is going to be a bearish mode. Okay, we show you another example here. You can see that it could actually has a region. That means the RSI can stay above 70. This is actually different from the previous example, which once it's reached 70, it's come back. This it stays at 70%. Okay, and now one is actually stay below. So staying below or staying above the region, you consider this is a continuous signal. That means when it stay above 70, the price can actually go higher and higher. It could have some correction, and it could be end of the trend. No one knows, okay? But when it's dropped below the 70% means the price can go lower in this case, okay? Okay, and later on, you can see that, if the price break below 30%, all right, it doesn't mean that the price will immediately rebound, but when it stay below 30%, don't buy yet. But you can accumulate, but don't buy and hope for it could rebound immediately. So this is how you so-called use the RSI. But RSI is actually consider midterm. To me, is midterm, okay, indicator. So next we're going to discuss about another indicator, which I'll give you more example in this indicator, is the stochastic. Okay, in this case, stochastic is a very similar indicator because they are classified as oscillator, which they have from 0 to 100%, and within the band it swing up and down. Okay, this is the indicator that we are going to share, and this is developed by George C. Lane, and this is considered short-term momentum indicator. The reason for short-term indicator is that when we use technical, we are more likely to be on a short-term side. Okay, if you're using fundamental, maybe you're more towards the investment and longer term. But of course, you can be a hybrid, which you use a short-term indicator, and then you are filtered by using the fundamental ratios or financial ratio, which we will discuss in a bit. Okay, it's actually very similar to RSI. The overbought is actually above 70 by my definition. Okay, someone could be like 80. You can set 80, you can set 20. It actually depends on you, and then the parameter you put into the stochastic. Okay, let's say for example, if it's above 70, okay, I'll consider a particular counter is in bullish mood when the stochastic is actually above 70, and it could stay above 70 for some time. That means the stock is in uptrend. Okay, and it will only ends when the indicator actually fell up of 70%. And in contrast, oversold is when the stochastic is below 30%, and this is considered bearish. As I said, don't just simply buy when it's dropped to 30, because it can stay there because of bearish, short-term bearish mood. Stochastic will indicate the price in short-term bearish mood. So the downtrend will only end when it breaks above 30%. And this stochastic has got, or STC has got a better representing of the indicator, which it has got a crossover trading signal, because stochastic has got two lines, which is the K line and the D line, or %K, %D. So these two actually, they are the moving average of each other. So you can actually use this crossover just like in, when you're using moving average, when a crossover, short crossover of a longer period usually indicate a price will likely to go higher. So that's why you can actually fire a buy and sell signal. So let me show you some example here. And similar or same as RSI, I will use 70% as the barrier or the differentiation of whether the market going to a short-term overbought. And overbought to me is equivalent to bullish mode or short-term bullish. So you can see that the price is actually above 70%. Sorry, if the indicator is actually above 70%, the price can keep on continue to go up in short term. It could be 2 days, 3 days. But once the price drop below it, okay, then it actually shows you the price can actually go lower. Okay, in this case, you can see that once this is actually above, okay, above 70%, short term go up, okay, and once it's actually drop below, okay, the price fall. But then if you monitor it closely, if you buy when the price break above, okay, which is about this region, and you sell when the price break below, which you back to square one, you don't make money, right? So that's why when in trading, you have to be creative a little bit. Okay, in this case, you could be well worse, by firing a buy signal when it's actually break below 30%, which is about here. Okay, and you can actually sell signal over here, which is this region, or you can use a crossover of D. Okay, this line is K line. In STC, you know there's two K lines, can be a color or dotted line. So when the K line, okay, let me clean this slide for you. Hold on, Okay, when this crossover happens, which the K cross over the D, you can consider this as a buy signal. And when the % K cross below it, you can consider this is actually much better signal because it's actually indicate you can buy around this region. This is the price of the stock, okay, and then you can sell around the high. Of course, nobody can actually catch the bottom precisely every time. You can once a while catch the low, which you can claim I know where's the low, but honestly, if you trade long enough, you know that you actually cannot catch the low and high every day. In fact, if you're trading correctly, you don't even need to catch the price at low or bottom and sell as a peak, because it's actually really not it shouldn't be something that you're looking for. Okay, as long as you can make certain change in price, which is actually we will consider that is a successful trade. All right, now let me clear this. Okay, I'll move to the next slide. Right. Okay, another one is actually you have to monitor will be the 30% level, which whenever this STC drop below it, so it actually for me is an indication of the price in bearish mode, which it could go lower and lower. So in this case, you should sell the stock, or you shouldn't keep a stock, but you will prepare to go in when the price or the stochastic or STC break above 30%. But of course, in this case, you can see that it has got a false breakout. So if you buy in this level, you may actually stop because the price can go even lower. And then only this one will be the correct one. So sometimes indicator, in fact, I won't say sometimes, most of the time indicator cannot be correct all the time. In fact, as a trader, you cannot be correct all the time, but you need certain winning ratio, which will give you a better chance of making money. Okay, so this is the two important level of using stochastic. But next, I'll show you some example which is more important than only follow the 70% and 30% alone. Okay, this is the formula of stochastic. Of course, you do not really have to know 100%, but having the formula will help you a bit, on why this happens and all this. Please bear in mind, all indicators has got flaws. The reason is because it uses price and calculate it. So once you do all this computation of prices, you have a problem called a lagged indicator. So that means the price will be, or the indicator itself is actually lag a bit, maybe 3 days, 4 days, or maybe the indicator cannot be rely 100% because of that lagged. So that's why most of the full-time trader, or if you're doing short-term trading, you need to look at something called time and sell or tape reading, which you can actually easily available by looking at the price and all this, from any software, or your broker will provide you with all the tool that you need. Well, of course, looking at chart is one of the easiest way to judge whether something, because visually it's actually much easier. For me, I prefer visually, but during my in day-to-day trading, looking at price is actually as important as looking at chart itself. So we move on to the next. There's another one that you have to understand, is that there is a variant called slow stochastic. Okay, usually most of the indicators that we use nowadays are slow stochastic. Slow stochastic is actually a smoothen, or indicator that apply moving average into an indicator. So that's why it calls slow. It gives you much indicative signal sometimes. So which we look at. This is the slow indicator or slow stochastic. Okay, and I'll show some arrows, which this stochastic actually fires you some signal going up, but stochastic is a very, very short-term indicator. So if you fire any signal, short-term long, short-term buy signal or short-term bullish signal, it's actually maybe good for 3 to 5 days. So you have to bear in mind the stochastic is actually meant for a short term. But of course, any long-term trend start with a short-term trend, right? So it could actually also spot the correct long-term trend or the beginning of the long-term trend. So, but when you're using stochastic, you have to be careful is during a sideways markets, the indicator become less useful because it just shows that the market is sideways, but market sideways means the market can only move maybe 3 or 4 prices for 1 week. That means whenever you catch a buy or sell signal, the difference can be only 1 cent or even minus 1 cent. So you could, not really make money if you're actually doing a trade for sideways markets by using stochastic. So this is the case you have to be careful. But as I said, when you're trading, really don't 100% rely on just indicator itself, because indication or indicators are good, but not everything that you need in trading. Okay, in this case, I'll show you another type of signal fired by the crossover of percent K and D. You will have a lot of buy and sell. So this is actually especially important for those who do short-term trading, like intraday, contra trading. This is quite useful because it shows you certain short-term swing for the price to go up and down. And I understand that as a trader in the beginning, you need to have this short-term skill to actually accumulate enough equity so that you can trade in a bigger size. So this is a good start, in terms of the choice of indicator that you can use for your short-term trading. But besides that, you can also use prices or which is dead reading. But there's so many things that you need to put together before it can consider as a package of trading strategy, which I'm sharing with you on how to actually build this into a trading strategy. So usually the easiest way to build a strategy is by using indicator, because you can have all the formulas ready and apply, and someone has done so many researches just to prove that this indicator works. So you just rely on all this indicator. Honestly, I don't invent the indicator myself, so I'm just using all the readily available. In fact, I'm using a handful indicator, or not many indicator I'm actually applying in my trading. So stochastic is one of the good indicator which I'm still using, day-to-day basis to check out whether it's oversold or overbought. Okay, so but there are some strategies built with just price and volume as well, which you can actually build a chart with pure prices. You'll be surprised when you see many full-time traders don't use chart at all, or some of the traders using chart that plot themselves. Let's say, for example, I still plot my own chart by using one-liner. So yeah, you don't be surprised that we use a very primitive way to look at the market. In fact, you don't have to be too complex when you're really trading full-time. So we'll discuss about this in a bit. Okay, now this is just to show to you, sometimes you don't have to be worried about the term that you use. Let's say, for example, as I said, sorry, this is overbought. I think I have a typo here. So overbought is actually bullish, means when the indicator go above 70%, okay, it just shows that the price, the share price can go up higher and higher. So it's actually overbought and overbought again and again, means the market is in bullish mode. So you can actually build with this kind of philosophy or methodology to build a strategy. But of course, to build a strategy, you need a tool. But first, what parameter to use? Let's say 14 days RSI, default one, you use a 933 stochastic, So how to choose this parameter or period? So one thing, easiest one is actually you browse the stock one by one. So they apply the indicator, see how this indicator responds, all right? And change the parameter to get the best result. Or using a computer backtest system. So today I'm going to share a little bit on how to do this, because you see, when someone tells you, okay, I'm using stochastic, how you know that this indicator is actually useful to your market or to the instrument that you're trading? Sometimes the indicator you are using, I'm using 14 days RSI, but maybe good for futures. But to stop, maybe 9 days is better, or maybe 20 days is better, or maybe 30 days is actually more suitable to your trading style. So you need to choose so-called correct parameters for your trading style. And also, you may actually overheard some seminars that I'm using stochastic to do this and that. But can you prove to yourself, okay, you're not biased, but you're using a real proven strategy for yourself? So here, I'm just showing you, okay, you don't need to know programming actually to do a backtesting. This is good thing about this. I'm going to share with you. And Bursa Malaysia has got very good tools also for you to filter up stocks, which I'm going to share after this as well. Okay, don't be alarmed because when you hear backtesting must be very sophisticated. Actually, I recommend everybody to do backtesting because I'm actually quite concerned when I see someone so confident on certain indicator. They will say this indicator I use this and this is very useful. I'm actually very concerned when someone tell me this because I've been trading so many years, but I'm not confident in any indicator that I'm using and able to say that 100% this will work, because something can work for this period of time doesn't mean that it will work for the next 10 years. So you have to be careful on this. But how to know whether this thing works or not, at least for the period that you are in or the period that you're testing, is to go through a testing. And during testing, if you go through the stock one by one, how many stock you can actually record, or you can actually imagine go through one by one visually? 100, 200, 500, 1000. Can you remember all this signal and give you a good statistic? You need to have a lot of samples. Okay, some people may have go through a bull run and thought they know how to trade stock, but that is bull run. Everybody can trade stock, but then can you actually survive when things may not be in your favor? So that's why you need to be very, very subjective in doing trading and adopt a trading strategy. So it is actually not a good idea to trade without you ever test it. Okay, and it's equally not a good trading idea if you're trading without a forward test. Means you really test your idea before you actually put in real money, or you put in your life saving into trading. Now the most important part, I think I'll be repeating this over and over again during my seminars, is to not fall into at least these 4 traps. There are more traps, but this is most important one. Whenever you do backtest, okay, is collinear effects. What is collinear effects is when you have an indicator showing you a buy signal, you go and confirm with another indicator. But if you look at 10 indicator, okay, for example, you put 10 indicator in your chart, right? You say that if 9 out of 10 indicators shows buy signal, I buy, and vice versa. If 3 show buy, maybe I don't buy. If let's say most of the indicators show me sell signal, so I sell the stock. It looks promising, right? Not really. This is a collinear effect traps, which you actually oversupply yourself with indicator too much, and you tell yourself and convince yourself, which is something that you shouldn't be, because you over optimize the strategy. If you use this, because it's so many variables, every indicator comes with 1 or 2 variables. If you have 10 or 20 indicator, so you have 20, 30, 40 variable which mix up, and you would not have a good result in long run. So don't ever do that with 10, 20 indicators to confirm a buy or sell signal. Second is confirmation bias. You always see the signal you wanted, because if you go through the chart one by one, you always see that, oh, whenever the SMA cross over 10, 20, so it's a buy signal. So if I follow this indicator, most of the stock that I bought, I make money. Actually, it may not be the case, because you may only sample 10, 20, 30 times, in your trading. So it gives you a small sample and a fake confidence to trade. So try not to do that as well, because confirmation bias is something that you want to avoid all the time. over-optimize means you keep on build a strategy or indicator which suits certain market 100%. You want to make money 100%. In fact, you know, sometimes when we do back test all this, we don't want to over optimize. So if I see a strategy that make money 100% of the time, I will actually just ignore it because it's not going to be exist, right? And because this will lead to a scenario called curve fitting. You try to fit the past market into the future. The future has not begin yet, but you think that what happens last time will 100% happen next. Actually, this is wrong. What happened last time could repeat, but it may not be 100% like what you wanted. So this is the 4 traps that I want, if possible, everybody remember not to over optimize or, you know, falls into this indicator trap. Now, to do computerized backtest, actually to take away of this kind of problem, because you test a lot of things. So that's why you won't have a bias, you know. You like certain counters, that's why you always see the good signal. But you don't like this signal or this counter, so that you always skip this signal, you know. So this will take the confirmation bias away from you. And you can't lie to yourself, because we will tend to do that. You see some things, you read some text, but you type something, but you read the other way. So yeah, it could happen. And statistically represent the system and strategies, because you need a big statistics to prove that this works. So test and create rules to be executed so that you can actually play around when should I buy and sell, to whether this will change the result. Sometimes you'll be surprised. You apply certain indicator, but you change the parameters around, it won't change the result. So you'll be surprised, right? So this cannot be done if you're doing manually. You can only do it without emotion, without bias, by using a computer. Although it sounds so complicated, but it's not. You can download this software called Ninja Trader. It's freely available. And download this software and test whatever indicator that you want to establish the strategy. So in this case, you don't need programming. You just need point and click and some understanding. Of course, the YouTube and a lot of community forum will help you to go. But I'll give you some idea how to do this, because you want to be an informed trader. You want to be an informed investor, so that you will stay long enough in trading and investing stocks, so that you can actually learn what is actually trading, because it could take 1 year, 2 years, you know, to understand all this, and before you can actually turn full time as your career. So in this slides, I will show you how to add parameters. You know, this is actually, if you don't want to do this, also can, because this is basically a full-fledged kind of inputs that I put in and all this. Second is use a stochastic, okay, to trigger a signal. So the buy and sell signal, I'm using stochastics to cross above this signal. So in this case, when stochastic cross above certain percent, I enter into a buy position. And because stocks you can buy, you cannot short sell first. For the moment, for certain stocks, certain stocks can be done, but in this case, we only use a buy side. So that means I will enter a buy side, and when the condition met, I have a buy position, then I sell. So I also put in profit target, 100% you make before you sell, or after you make 100%, you need to sell. Stop loss order, and also a trailing stop in this case. But this is actually not important also, because you can actually skip this part, still able to do it. As long as you use a stochastic buy and sell signal in this criteria, you're actually good to go. Now, then if you are good in programming, or you know how to write a bit of coding and all this, then you are in luck, because you can actually modify the code to give you a better feel, give you a better in terms of sophistication on building up the strategy. But today's seminar, we focus on how to prove this indicator, whether it works or not. Because when you're in trading, you need that confidence to be able to trade. Now, this slide shows you the strategy of using stochastic works, okay? Because I test in certain stocks. Let's say, for example, in this case, these stocks actually yield a positive total net return, okay, which is positive. You lose some money, okay, but not a big deal. Overall, you accumulate quite high in terms of profit, 101%, and your drawdown is only, let me show it to you. Your drawdown is only, maximum drawdown is only 2.4%. That means, which is very, very good. Okay, but of course the SAPI ratio is not very good in this case. I'll show you why also. So you make money, but you lose a little bit of money, but your average total trades, all these are okay. And this is more like investment type kind of thing, because you don't trade a lot, but you have a very positive return. Of course, because I optimized for the low drawdown, so you have less trade. Now, and the good thing about computer trading is you use this chart to show it to you when you enter and exit a market. You can see from here, you enter into a market at this price. Let's say, for example, let me use, okay, and then you sell at profit target, which is exactly the point before the price fall down, right? Yeah, in a way, you actually has this kind of indication, but also you will lose some money when the market is in whipsaw. But can you execute this kind of orders? Then you have to be very, very robot. You know, you work as a robot. We call this kind of trading called, you know, usually computer trading, you don't have emotion, but when you're actually trading with emotion, then you can't execute orders like this. But if you train yourself to be like that, for example, I'm trading like this, so I just go in by following my own strategy and rules. I just go in without thinking twice, because you need to have that kind of belief in your strategy before you can actually execute certain trades. So this is one of the example. You can actually trade by using the generated signals. Okay, let me clear up. Right, we move on to the next slide. If you have questions, so please ask me in the bit, because I'm sure some of you are interested how I do it. But as I said, don't satisfice by just looking at the result is positive. Then can I just use the strategy and trade? Not so much 100% yet, because you need to test over other counters as well. You can't be just pick one counters, one chart. You study this work, and this counter can use this. But can you apply the similar method or strategy into another counter, which will give you a similar result? So in this case, I can show to you the indicator is actually not perfect, because it's only one strategy, but it's actually able to generate positive return, because I tested all these different counters by using the same strategy. So most of the counter actually give you result, but 3 out of like 20 are losing money, but which is fine, okay, as long as it gives you a positive result. But of course, is it enough? Not really. You need more to help you in terms of trading, okay? But this strategy, excuse me, this strategy itself is not perfect, but it works already. It works already. You need to prove first thing first whether I can apply indicator into stocks trading. So in this case, proof stochastic works, but whether it gives you an edge in trading in long run, not necessarily. So you need more than trading with just an indicator. Let's say, for example, it won't work. Let's say if you have 10,000, okay, 10,000, and you go in every time you go in 10,000 in your trades. I don't think this will work, because you see, this is 20 counters, for example. But if you put in all the money into one of the counters that don't make money in long run using this indicator, you lose all the money, or you lose some of the money. But you, at the same time, you don't make money for other counters that you actually need to invest as well. So this strategy works only if you apply everything like in what I did, which over the 20 counters, you put all the money in proportionate to each of the counters. But of course, there's certain rules you can follow also, which I will show you in a bit. We call position sizing. But before that, one of the methods that I use usually when I filter up the stocks which fire a buy signal, I have just a small trick which helps a lot. Okay, whether this signal will work, because buying stock is only buy. You can't sell first, for example. So what you do is you filter up stock that meets the fundamental, good fundamental prospect. So this will improve your winning rate of trading signal, of this particular trading signal. Yeah, somehow it's actually over optimized as well lah. But this is a trick that I find that it could improve your trading in a very big way. So you can use the fundamental elements. So this, I'm using a method called filtering with financial ratios. So where to find these financial ratios? Bursa Malaysia has got a site called Bursa Marketplace. This is the best place for you to look for this. Okay, you can go to the screener, which on top of the toolbar there, okay, the home and education, game, and so on and so forth. Click on the tool, which is the wrench icon, and click the screener. Okay, once you create a screener, you can have a choices of, using what type of financial ratio to filter up stocks. In this case, I recommend 3 only. First is the PE ratio. Second will be price to book value. The third will be earning per share. Okay. In this case, I'm choosing the PE, which is from 10 to 15, which is just right, before the market go into a bull run, and also price to book, which is actually below 2, 1.6, that kind of level, and earnings must be growing in certain percent. But in this case, as long as the earnings is actually growing, so this stock is actually good to close. So once I apply all this, I have a total matches of 75 counters. So from here, I click the shows results. It gives me all the counters name. So in this case, what you can do is you can use these counters to filter up using, let's say for example, the stochastic strategy that we just used just now. All right, and apply into filtered stocks with all the fundamentals. You actually will get a much better returns in terms of the stock that you filter, because certain stocks that don't have a good PE, they said, for example, the PE may be very high, so you may not actually enter into that stock. But it's okay, because you may miss 1 or 2 stock that really go into a bull run. But as long as you make money in long run, that is actually fine. Believe me that trading is not about make a home run in one stock. Trading for a living is making some consistent money every month, and treat this trading as a career. Then you're actually good to become a full-time trader. But just with all these tools may not be enough. Again, it may seem so complicated to trade, right? It's actually no, because the center of trading is here. You need to have a money and risk management system, because having a trading signal is not yet 100% a complete system, because the center of all successful trading is actually on risk and money management, and most traders fail in this part. So if you fail in this part, if you have the best signal in the world, but it's not going to work still. Now, risk management is the center of all trading or successful trading. I'm using a very simple way to apply this, using a risk 1% rule, which most important at all is actually cut loss lah. But what is actually how to cut loss, which is 1% rules, means, let's say for example, if you have 100,000 in your account, okay, you buy a stock that price at $1 or 1 ringgit, with cash, means you risk all the money into this particular stock. So and your returns totally down on this one particular stock, then you are investing into this company. But actually for trading, you should not do this because you can actually try something else, which you limit your loss. Okay, so that 1% is the limit of the loss. 1% means if you have 100,000 in your account, every time you trade or buy certain stocks, do not risk more than 1,000 or 1% of your equity. That means you have 100,000 in your account. Every time you buy one stock, if that stock lose more than 1%, in this case is 1,000, cut loss. If you cannot cut loss, then you need to find some hedge. But in stocks, so far, unless you go to the single stock futures or short selling, otherwise you can't hedge directly unless you're trading in bull chips, then you might. So set the maximum loss you're willing to take, which is 1% in what I'm actually recommending to you, and set the cut loss level from your analysis or backtest. Let's say you cut stock at 10%, okay? Then if the price of the stock falls more than 10%, you must cut loss. And that 10% is actually equal to 1% of your equity. This is actually very important. So calculate the position size based on this, and you actually each trade how many or how much equity you're going to risk into one single trade. So you can find out position sizing, which shouldn't be a big problem. Okay, the problem is whether you stick to this formula all the time. I tell you, what I do is because why I can trade full time, because I stick to all these rules all the time. To me, I have no second guess whether this will work or not, because I trusted this 100%, and this is what bring me to what I'm doing now. So that's why, to me, there's no second thought whether this will work, because I need this, and this is the only way work for me. All right. So if you're 100% in your equity, so if your risk tolerance is actually 1%, which I'm recommending now, your stop loss is actually 8%. You can put 10% and so on and so forth. You can build in an Excel just like me. If the share price is 2 ringgit, you can calculate your position size should be 12,500, which is just by using the formula. Okay, or be creative lah. How to get this formula? In fact, you can Google. You can just snapshot this into your phone, and then you try to get this formula out. So you can calculate your position size should be 12,000. If you cut loss at 8%, then you are losing. Your stop loss is actually 1 ringgit and 84 cents, and you lost maximum. You're losing 1,000 only. So this is how you actually manage your money. Now, building a strategy may not be too complex. You need a system that can give you a positive result over, for long term. Because if one good trade or good day, even months does not count, right? Because you need that long-term system to give you that long-term profit that you wanted. Because once you become full-time trader, you may not be making money every day. Sometimes you may have losing day, unless you're doing a lot of scalping. If you're doing scalping, then I'm sure Bursa Malaysia will have, or your broker can introduce you to another program called day trading. So which you will be actually have a very low brokerage, okay, and then you can do buy and sell stocks intraday. If that's the case, then you need a much quicker way to trade. You may actually build your own system, or you may actually look at price alone. All right. So once you have a robust system, practice it by following all the rules defined. Now, next thing, you need to define the rules by yourself, when you should cut, when you shouldn't cut, for example. And maybe I give you some hint. Stocks usually move when there's some news or there's some fundamental change. In fact, all the prices in the world behave that way. That means whenever there's a signal, there's some big thing going on, the price tends to move in tandem with that signal. So, for example, every 3 months, this all the stocks, all the counters in Bursa Malaysia will announce their financial result. So that is the best time you actually look for any signal in terms of technical. You can look at any signal in terms of fundamental ratios. Let's say, for example, they improve in terms of earnings. Usually the price will move in positive direction. But things sometimes don't work directly to you. It may move first or it may move one day later, but if you have this kind of statistic or you have this kind of information, then you can actually get this from your, I mean, for your advantage. Bursa Malaysia has got a website, you can check out on the company announcement. Every 3 months, quarterly, they will announce all these results. This is the website you need to look for. Besides only look at technical, but of course you can using the other way around, just like what I'm showing you. Use your system to filter up stocks that you wanted in terms of technically, which the stock will be moving up, and then compare this to the marketplace financial result. If both are actually giving you promising indication, then you actually good to go. So once you have this, you have to define the rules. Don't expect to define the rules, in one day. You may need some time. Okay, if you don't have a system to follow, you may build your own, but it could actually take up to, I want to say 1 month, but actually, to be frank with you, it may take to 1 year, and so on and so forth, at least to build a solid system up. So be patient a bit, which is very important in trading. You have to be very, very patient. Because what I can say is most of the time when we have a losing position, if you're patient enough, the price actually come back to you. But of course, by having said that, then you don't cut loss, which is very dangerous. So you still have to follow the rules, whether you should cut loss in 1% or you hedge your position. Okay, so for stocks, combining financial result actually will give you much better result in terms of the money that you can make. So with this, actually, I'll end tonight's seminars. And if you have any question about the system or the website I'm using, so please, we can go to discuss a bit on the Q&A session. I'll pass back to Chun Sen.
All right, thank you very much, CC. There are already questions on how to use oscillators. Okay, but before we do the questions, let's launch a poll. All right, so on your screen, you will ask, do you often rely on indicators to trade? So please select one that's applicable to you. All right, is it yes or is it no? All right. Well, in the meantime, if you have any questions, please put it down in the box. All right, in the chat box, and then we will raise it. Okay, there are 70% of you have voted. Okay, let's give another 20 more seconds. Okay. So do you often rely on indicators to trade? Yes, sometimes, or not at all. I just want to know how many of you really use indicators. Okay. I guess for those of you who do not use, you're probably an investor. Am I right? All right. So I'm going to end the poll now, and we'll get the results. So this is the result. Okay, today we have 37% of you use indicator most of the time, and 42% of you sometimes use indicator, and 21% of you don't give a damn to any indicators. Okay, and I guess you all are a investor. Okay, now, well, I will just hide the result, and then it's time for us to go to a question. Okay. Now, the first question that we have here is, when do we use the oscillator? Like on which time frame? Is it a 1 day time frame, 1 week time frame, or 1 month time frame? Which time frame is more effective to use oscillator?
If you're trading stocks, I would recommend you to use daily chart or daily bar. So that means your default chart will be day bar, and then the indicator you're using effectively in daily bar as well. So of course you can actually choose to another time frame I'm often used is actually 5 minutes chart, but for stocks, I wouldn't say unless it's very active. Otherwise, it could actually too fast for any indicator to actually react to it. So I'll choose day bar for all the method I'm using. In fact, I'm testing it in daily bar.
Okay, so now if we use the if we look at 5-minute chart, let's say we do it at 5-minute chart, is it still the standard setting apply, or is you will tweak the RSI or stochastic setting so that it is more faster, or it is the setting is just right for that time frame? Do you do modification that way?
I think it's very good question. There's two parts to answer this. First, whenever I use the indicator, I have the luxury to backtest it using any time frame that I wanted. But I tend to stick to one setting, okay, rather than multiple time frame but multiple settings. The reason is because it will actually give you a different result, right? But the reason I'm do that because I don't want to over optimize my system. That means I don't want, not to say I don't want, I don't believe if I optimize it further with any way that I can afford to do it, it can actually improve the results significantly. But you can only bring disaster to your trading because you over optimize or over curve it your system. So allow the system to have some flaws, but how to repair the flaws is something that traders or investor need to learn along the process, which I can not stress enough. The only thing that you need to repair this will be on the risk management side. So once you get that covered up, you don't need a perfect indicators or system to actually able to trade and make money.
Okay. Now, since you say that the RSI is a mid-term indicator and stochastic is a short-term indicator, can you comment like which one is more appropriate for 5-minute, 15-minute chart, 30-minute chart, or hourly chart, or daily chart?
Again, if you ask me to pick one, I'll pick stochastic all the time, because
all the
stochastic
time.
has all the time, because you don't need to have both oscillator to help you. You can as I said, collinear effect. So you can have RSI and stochastic. So stochastic maybe give you 3 days, 5 days, and RSI give you 14 days. But yeah, you only need one indicator to help you in terms of trading, because if you go in with stochastic, you need to go out with stochastic as well. So otherwise you can't. You can actually backtest the system with go in with one indicator and get out with another indicator. But I would strongly recommend do not backtest with so many indicators. So far, try to use only one. I will never use multiple indicators into my trading system, because usually it won't work. It won't work in real life trading. So it may give you a very good backtest result, but it will never really work in actual trading with multiple indicators in play. So pick one. I'll pick stochastic.
You pick stochastic. Oh, okay. Yeah. For me, my experience is that stochastic give me more signal than RSI lah. So I would still prefer stochastic because give me more trading opportunity when I do that. Yeah. But so the next question is, based on your experience, what are the parameter of stochastic or RSI that you think it will work in the Malaysia stock market?
All right. I think I have the slides. Actually, okay. Usually
it's still showing your slide. You can go back to your slide because it's still showing your screen.
Oh, okay. Where is the screen? Okay. Here you can see that I'm using stochastic 14 as a default period. You can use a 9. Okay. You can use a 3, but in this case, I'm testing using 14, and 3 is for the stochastic D lah. The slow factor is actually 3, so you can actually have this default. But again, as I said, it's not that critical. You choose one particular parameter. You can choose one parameter and stick to it. But you can also use this software, which is the Ninja Trader. You can ask the Ninja Trader to test from, let's say, 3 to maybe 20 in terms of the K and the D, to give you a best result. But as I said, stick to one. You can just use the bare original or default setting. Use that to test. Then you can actually see whether the crossover of 80% or 20%. In fact, sometimes I play around with the stochastic. I say break 20, buy, break below 20, sell. So it actually, honestly, it doesn't change the result that in terms of big change, but rather it will have specific pattern for different counters. Certain counters, stochastics won't work no matter how you tried it. Certain counters it always works no matter how you apply the stochastic. So you have to come up with a characteristic of certain stocks may actually give you different result. But all in all, you can pick one indicator and apply to most of the stock. Okay, because it's not practical for you to choose one indicator for one particular stock and so on and so forth. So because you are trading stocks, stock has got multiple counters. So I'll believe there's two ways to get this going. Filter stocks with indicator, and once you have the stock filtered, doesn't matter the parameters. Okay, I'm using the default. Okay, it's 1433 or 14 days, for RSI. Right, and then couple with the financial ratio, which I just told you, P ratio, very simple P ratio. Everybody gets it. You can even calculate yourself. Price to book ratio, very simple as well, which you need the tangible asset. And thirdly, earnings growth. If you have a stock that growth in terms of earning, usually this is a stock that I will only go in. I won't buy any stock that can't even have a growing in terms of earning per share. Of course, certain stocks you make more money if you invest in this kind of stock. But what you want is actually long-term profitability. Then you need to choose this kind of stock also. So after all, pick the default setting, which I think most of the software in the market, they already choose the default, which is 14 for RSI, and then 933 or even 1433 for stochastic. So yep, you can pick the original one, backtest with the way that I showed to you, then you will understand the indicator is only play a part of trading, not all.
Okay, so for you is 14, 3, 3 and 30 and 70 lah. Am I right?
Yes.
Okay, great. But personally, right, just to share with the participants, I use 10, 3, 3 more. Okay, I use 10, 3, 3, 20 and 80. Okay, so that's my preference. But anyway, it works for you even if you pick a 9, 3, 3 or 12, 3, 3. Okay, so it's up to you and see whether your backtest can yield the best result. I guess CC has maybe done a lot of backtests, so probably 14, 3, 3 is the one that works well for him. Now, I got a very interesting question here who asked that why use indicator if price movement is largely dependent of the big traders buying and selling, like maybe market operators or market makers who move the shares, no? So can another question is, can indicator like this inform when the big trader is in?
Okay, the question is actually a bit big lah. Okay, in any market, there will be a saying that a big player move the price and all this in futures, in anything lah. Okay, but you see, sometimes the market is actually doesn't trade simple one direction. It can do both. Okay, so why use indicator in this? Indicator is just a form to build a strategy which you have a plan to follow. It doesn't matter the big trader or trader or any mover, okay, to corner the market, if you want to say that, which I don't believe so. It's not easy to do this actually, especially very developed market or the stocks is actually quite liquid. Or if you pick the stock that I'm recommending using the Bursa marketplace to filter all the financial ratio, you hardly for you to find this kind of stocks. Okay, this is what I believe. Right. Second is that using the stochastic or indicator that any indicator that I backtest, I'm actually filtered up, or should I say, I believe in technical analysis, which all this factor has been factored into the price. So if I backtest all the prices with this indicator, I already including all this movement into my strategy. So it's not a perfect strategy. In fact, I wouldn't get a perfect strategy. But if you're going to a trading every day, in fact, I heard this story quite often. Every day you actually cautious of any big players into the market, which will stir up the market or will take up your price and push you away and force you to cut loss. If you're thinking of this, it's very difficult for you to trade. Every day, the market I'm trading is connected. Everybody will be trading into the same market 24 hours. Let's say, for example, yeah, there are some big players which 40 times, 50 times bigger than the size I'm trading. They go in one times, the size they're trading is actually 40, 50 times bigger than me. So do I actually get squeezed by them? Not necessarily. Sometimes I actually prefer them to be there because they will push the price where you wanted it to be filled. You see, you want to sell a price, you need someone to buy your price, right? You need a big player to buy. You want to buy something also, you need a big seller to sell it to you. So if you have a strategy that developed and so robust, you have all these parameters included in your system, which actually you don't have to bother, because once you backtest and the statistic, as I said, the more sample you go into your strategy, it already included all this big movement, then it should be fine. Of course, if you ask me, should I use indicator because the price is the one that more important? Definitely. As I said, if you're trading more in terms of trading so-called intraday, then you need to look at the price, which is the time and sell, which give you more indication whether there are more buyer or seller side. But believe me, even that, it's not going to be easy path for you to trade just by knowing this. Okay, because you need to create a system. You don't have to look at other people in order for you to trade. You need to build a system. You need to do something. Not to say ignore. That take into this account and you're able to trade. So thinking about having this kind of big players in the market is actually not going to help. Certainly, as I said, every day I face this kind of traders, but I not to say I have no fear, but my experience let me know that as long as I head down and focus on what I'm doing every day, I should be fine. Because the good thing about electronic trading is almost everybody has got a level play field. So you put an order, as long as you're the one who's faster than the other guy, so you are in front of them. So it is, of course, there are some front running happening, but you don't have to be so worried about that. Sometimes, of course, a lot of funds, they use this AI or algo to front run to get prices better and so on and so forth. But if you're trading as a manual trader, don't worry. It works by building your own strategy and believe in your strategy. Part at the price that you wanted, it will get filled. Don't be panicked and then sell according to your strategy, because the history price will tell you this thing works regardless of what other people are doing. So look at the intraday prices may help if you're doing intraday trading. But if you're trading a strategy, most of my trades are strategy. So I can tell you most of my stocks are parked and filled by this kind of big players. All right. And I keep on parking my orders. Let's say, for example, I park at the support and resistance. So yeah, this is how I trade. And it works regardless of who is the player and what is the player trying to think. In fact, I never try to figure out what they are doing, because there'll be always a saying that the traders squeeze the retailers upside down. I don't put my mind into this kind of thinking. First thing first. Second, I don't believe this is really happening. Third, to me, it doesn't bother my trading, so I don't bother to think about this. So sorry, very lengthy, very lengthy answer, but I try to give a point. system trading is you trade. Although I don't execute my orders with AI because it's not easy. You need a lot of setup before you can use computer to trade without emotion. But I try best knowledge that I can to trade without emotion, so that I execute my trade. Even I see a big orders flow in and out. So to me, I'm just following my own system, my strategy. The order will fill, regardless who will fill the orders, whether someone will get squeezed or squeezing others. So yeah, so I just let my system or strategy work for me.
Okay. Yeah, I understand that. So is there any indicator that can track the big player coming in or not? That was his second question.
Someone may have, but I don't. I don't think I have this, because you can see that I don't believe in this kind of way of trading. So that's why,
So
although
you're not aware.
someone may have it, but I don't have.
Yeah. As far as I know, I can't think of any indicator that can track the big funds coming in. But do check out this company called Fiavest. I think their system can tell which are the big orders coming at what tick, I mean, what price. So next question is it enough to be full-time trader by trading only Malaysian equities or derivative?
Answer is yes, very much. In fact, in Malaysia, there's so many full-time trader, but usually maybe not aware. Trading stocks and excuse, and also futures. All right. There are PDD program for stocks. There also are local participant programs for futures. So these two are the programs that provided by Bursa Malaysia for those who intended to trade full time. The question is whether enough. Yes, enough, because as long as you can trade and generate money that cover, of course, it also depends on how much capital you put in. So you don't really have to trade so many different instruments. And if you ask me a question whether I trade overseas product, my answer is no. I'm purely trading Bursa Malaysia products, and to me this is actually a good opportunity, because we are the one who sit in the country itself. The stocks, the commodity, palm oil, all these commodities products are in Malaysia. We are the one who know whether the weather, raining, flood, okay, so any change in terms of government policies. So we are the one who actually first know. So we should actually able to at least be the champion of the kampong lah, before you can try other product. That's for me. Second thing is why also I choose to stay mostly locals, because of the currency. Because you know that ringgit against US dollar is actually quite fluctuate, and expect to be fluctuate maybe the next 4-5 years. So if you actually invested some instrument in US dollar, if ringgit strengthen, you actually suffer some losses there. In fact, it could be very big losses. Let's say if ringgit strengthen from $4 ringgit to 3 ringgit, you're looking at 20% loss in terms of your foreign currency. So you have to consider that as well in terms of investing overseas, which is possible. I can see many traders trading overseas product are still very successful. But yeah, currency wise, you need to think twice as well.
All right. So now the next question is, what is the difference between stochastic and MACD?
Okay. Stochastic will be giving you more towards the signal is actually much more sensitive compared to MACD. MACD effectively just few moving averages, so it gives you the momentum of whether mid to longer term kind of movement. Stochastic will be focused on very short term, 3-4 days, 5 days. You can consider this as a swing trading, small swing trading. So yeah, basically the biggest difference is actually in terms of stochastic give you or more focus on the shorter term indicator, which is suitable for you if you're doing full-time trading in stocks.
Okay. Yeah, I think stochastic is an oscillator, but MACD is not an oscillator. Yeah. So the next question is, I know RSI and stochastic can mix with simple moving average for a better result, but how about directional movement system? That the person asking is that he mix it with simple moving average, but the result is totally different. So can really this directional movement system indicator mix with others? So that's this question. Do you understand?
Maybe I understand from mixing two excuse me indicator, but as I mentioned before, don't mix too many indicator if you're building a strategy. In fact, if you're building a strategy, pick maximum one indicator, okay, and then the next thing you need to develop is actually not mixing other indicator to give you better result, because that is actually conflicting. It's actually improve your risk and money management. How that is actually requires a lot of actually so-called practice, But one more thing maybe I didn't mention is that also set your expectation to be reasonable. So if you want to set your expectation to be, if I put 10,000 every month, I can make 10,000. Not easy for a beginner. So in fact, I don't recommend this kind of expectation. So you also need to consider about this. So mixing indicator will give you different result, definitely, because it will give you very different result sometimes and too complex and you cannot control. My backtest always shows me if I mix too many indicators into a system, it's very difficult for you to execute manually. So every time you have to look at 3 or 4 indicators and you don't have a very good statistic to back why you should do this. So yeah, in fact, I don't recommend you to use 2-3 indicators into trading.
So you only rely on, for you personally, only rely on oscillator, RSI, stochastic, and naked chart lah.
Yes. Of course, I use moving average also to help you to trade, but when you build a system, don't use too complex. Okay, so sometimes you look for stochastic signals, just use that. All right, or sometimes you use moving average to build a strategy. You may actually look at stochastic to help you whether this is actually slightly better signal, but don't mix the 2 indicators to be confirmed bias. Only you go into one trade. That wouldn't work in long run actually.
So so when you do back test with NinjaTrader, you can pick the market that you want to back test with, is it? Or NinjaTrader run across all markets that have price action?
Okay, you can choose the data that you have. They allow you to download some data from their database. Okay, you can actually choose which, you can group them into market. You can backtest all data that you have. That means whenever market the data you have in your computer, they will test for you, or you just choose one particular counters. But in my case, I choose all the counters that I put in all the data into the NinjaTrader.
Oh, so that means the NinjaTrader itself already has Bursa Malaysia price action data, historical years.
You have to purchase most of them. That what they have is actually mostly in terms of futures and indices. But for stocks, you actually have to download and put into the NinjaTrader yourself.
So we probably need to buy data from Bursa Malaysia and upload it in the system so that it can run the indicators or the data that we uploaded and see how effective is the system, is the strategy.
Yes.
I see. Excellent. Now the next question is between RSI and stochastic, which has more noise, like false signals, and apparently stochastic used to have a lot of false signals.
Yeah. In fact, stochastic will have false signal when I just mentioned when the big trend or the market, the price is in sideways. So once you see a very significant sideways market in a particular counter, stochastic will have a lot of noises. So RSI also will have noises, but the noises come maybe 14 days later. So stochastic will have faster noise whenever the market is sideways. So don't use oscillator when the market is sideways. So yeah, so that's why if you use an oscillator in sideways, you also buy and sell a lot of noises, and you end up not making money. So more noises, stochastic, but how to filter that is difficult. If you're using manual trading, when the market is in significant sideways, or well-known market, overall market is very quiet, using oscillator will give you a lot of noises, which you could actually lose money. So you have to know that, yeah.
All right. So how does open interest relate with oscillator? So that's the next question.
I don't see open interest combined with stochastic. But I do look at open interest whenever, let's say, because open interest is actually more or less trading futures. So especially when certain contracts, to see whether this is actually active one. So open interest is one of the best way if you go into any futures market. Whenever you see open interest is high, then that is the contract that you should actually look for. But combining with stochastic, I don't see a very significant trading signal. But if you apply an indicator into a contracts that you're not aware of, let's say for example, you go to trade Bursa Malaysia future FCPO, crude palm oil, you don't know which, because they have so many contract months, you want to apply an indicator backtest into one of the contracts, which one to choose? Choose the one with highest open interest, because although there are many contracts, one is the highest, and then the second one maybe not the high, but maybe the January, February has got no open interest or very little open interest, but March may be more open interest. So January has open interest is high, February may be very low, but March can be higher as well. So you can trade January and March and apply this your system into this particular contract. But you could, or you may want to skip February because of low open interest. Yeah, that could work actually.
Okay. All right. So the next question is, just now when mentioned that when a stochastic crossed 30 or 70, do you refer to K line or both K and the D line?
For stochastic, I refer only to K for that 70 and 30.
K line lah.
Yes.
I mean, when K cross 30 and 70, it can give you a buy or sell signal according to strategy. A D line does not matter lah.
Yes.
Okay. Okay. So the next question is, K cross signal validity should be occur above 70% and below 30%, or it can be anywhere between 0 to 100%.
All right. The K cross below, cross above the D is actually preferable to happens below 30. Very good question actually. And if cross below, that means the sell signal will be above 70, which is the best. So that means for buy signal below 30, K crossover above of D. So for sell signal above 70, K cross below D. Yes, very good question. Thank you.
Yeah, it's a very good questions. All right. So the next question is it trading with naked chart better than indicators?
Depends on what market you're trading. I would say there's certain market that I'm trading. I'm not sure whether you're aware.
Let's
actually, I'm trading. Yeah.
Let's talk about stock. For stock, like,
If
is it naked chart?
Actually, can, because most of the market, let's say, for example, especially if you're trading different time frame, let's say for example long-term trading, you can look at chart pattern without looking at indicator, because you're investing long term. So you need to know where is the double bottom, where is the support and resistance. So you can look at the naked chart alone, but looking at naked chart has got one drawback, which you need to interpret all this by yourself. So whether how many bars it has been dropping, how many bars it went up, so whether this is actually within 20 bar signal, so 20 bar breakout. So you need to look at all this mentally. But if you look at indicator, choose one, okay, then you will have confidence whether it's below 30, then so I look for buy signal. If above 70, I look for sell signal and keep the stock lah. So that's why it depends on what market or what kind of time frame or what kind of trading method you're looking at. But if you want to look for fast trading signal, so you need to rely on something that gives you a very clear-cut signal. Every time this happens, this will be the next. So if it's wrong, then I cut out at 1%. So stochastic or indicator will give you a very simple trading idea. Thirdly is using bar alone. It's very difficult to program into any computer. Not easy, possible to fire up a buy signal. So you can say every 3 bar positive white bar buy signal, but it's very hard to program this way. But it's much easier if you pick one simple or common indicator and try to build a system out of this. So for a starter, using indicator will be a best start for you to actually prove any trading method, whether it's actually workable or not. Actually, what I expect is once you understand you can backtest this kind of thing, you will actually start to build, start not to listen to so many different ideas and start believe in yourself building the system. And it takes some time, okay? But once you get this, it will be something that works for you in long run. So building a system or try to figure out a system how this works on naked chart itself is far more difficult, because to program a chart pattern recognized system, you probably need an AI already. So yeah, it's actually much difficult to just put this into NinjaTrader. In fact, in NinjaTrader don't have a chart recognized system or pattern recognition system in their BN formulas.
I see. All right. So yeah, probably we'll come to the end of this webinar. Let me take back the control first. Okay, show my screen. Are you all seeing my screen now? Okay. Well, let me go to all right. So here are some announcements. Like in case you are not aware, all new investors will be given a fee waiver on trading and clearing fee for 6 months effective 1st March of 2018. And second announcement is that the stamp duty on shares for mid and small cap companies will be waived effectively 1st March 2018 for a period of 3 years. And stamp duty for contract notes on ETF and structural warrants will be waived effective 1st January 2018 for a period of 3 years as well. So, and lastly, no GST for all, no GST imposed on the, so 0% GST imposed on the trading fee, clearing fee, and the brokerage fee as well. So, well, next webinar, we will talk about SMA crossover method, how you can rely on simple moving average to make decisions. Okay, when which time frame we're looking at, I mean, and which moving average crossover are we looking at? Are we looking at long-term moving average or short-term moving average crossover? Is it 250? So in next webinar, we'll talk about which are the more effective SMA crossover technique they can look at and they can yield you a good result. So it's on 4th September 2018. It's a Tuesday, 8:30 to 10 o'clock. So if you want to register, please go to the chat box. The registration link has been sent to you. Please click and register for our next webinar where we talk about how to use simple moving average crossover method. With that, thank you very much, and thank you, CC, for tuning in today to share with our audience on your valuable insight on how you use RSI and stochastic to trade the stock market.
Thank you.
Yeah.
And good night.
Thank you very much. Yeah. So, and have a pleasant rest of the day, guys. Thank you for tuning in.